Oh, that's great. Okay, let's start. Okay, welcome everyone. Now I'm just going to mute all your microphones so that there's no other background noise. All right. Okay, let's start. Okay, so welcome to our online seminar for tax saving tips on rental properties. My name is Brenda Ferguson, and I'm from Impact Taxation and Financial Services. Most of you have known me already, and I have listed our contact details here. If after the seminar you have any questions, please feel free to give us a call or drop me an email. Okay, now start. Okay, before we go to the main content of the seminar, I'd like to mention that this seminar is basically for general information only. So if you have any questions, please make sure you check with a registered tax agent. And also during the seminar, please make sure you don't provide any of your confidential information. So during the seminar, after every few slides, after each section, I'm going to give you a chance to ask a question. So you can type in the field on the right-hand side, or you can unmute your microphone to speak. So when you type in, other people won't be able to see what you have typed in there. But when you speak, other people can hear you. So make sure when you ask a question, especially when you speak, don't reveal any of your confidential information. Okay, so when we talk about tax issues on investment properties, there are mainly two big groups of tax issues we need to consider. So the first group is when you're holding investment properties from year to year, you need to consider income tax issues related to ongoing rental income or loss. Okay, that's from year to year. Then another group of tax issues you need to consider is when you're selling an investment property. When you're selling a property, then if there is a capital gain or capital loss, then capital gain, you might need to pay capital gains tax, CGT. So that's the other group. So that's how we're going to structure our seminar today. So the first topic, we're going to focus on issues related to when you're holding an investment property. Okay, then the second part will be focusing on how to help you to reduce your capital gains tax when you're selling an investment property. Okay. All right. So when we look at the income tax issues, when you're holding an investment property, we need to understand how tax is calculated from year to year on the income or loss on the rental property. Okay, so basically it's rental income minus rental expenses multiplied by your ownership percentage. Okay, rental income, we have a few different sources potentially. But most of the people, when they talk about rental income, they only think about rental income from the tenant. So rental income is not going to be a main focus of our seminar today, but I just want to quickly mention it, just so that if in case tax office want to audit you and they don't find missing income that you didn't include your rental income, that might cause some issues for you. But basically, rental income can include rental income from the tenant, and it can also include other income, such as when you rent out part of your home, or bond money when you receive from the tenant, when you're entitled of the bond money. You know, initially, tenants have to pay a bond money to help cover potential damage in the future for the rental property. So when they do cause any damage, and then you are entitled to deduct a part of the bond money, then that's the point of time you need to include that part of the bond money in your rental income. Okay, and then also sometimes if you have insurance that's related to the rental property, when especially with landlord insurance, a tenant might not able to pay you for a period of time, then you might be able to receive a claim from the insurance company. Then when you receive that claim payment, it needs to be included as a part of your rental income. Okay. Also, if you receive reimbursement of any deductible expenses, one example, say you might have paid water expenses, then the tenant might pay you for a part of it. Then when they pay you, you need to include the payment from them as a part of your rental income. And then on the other side, of course, you can claim a deduction on that expenses you have paid. Okay. All right. Just a briefly touch base on rental income. Then it's going to be our major focus today on rental expenses. So rental expenses cover quite a few, like a wide range of different items. So the major parts are loan interest if you have a mortgage related to the investment property. Also, depreciation is another major part of the deduction, including capital works and capital allowance. And then on top of that, there are other expenses such as land tax, council rates, water repair maintenance, and things like that. So we'll cover those expenses in more detail later. Okay, let's go to the next slide. Okay, so when we talk about especially initially when you purchase a rental property, sometimes very simple mistake people can make is they don't know how to set up the ownership properly. So remember in the last slide, we have mentioned the ownership. Okay, so the way you include a rental property in your tax return is rental income minus rental expenses, multiply the ownership percentage. So this is the critical factor when you're calculating your tax. And then it's a very common mistake people could make. So when you set up, when you purchase an investment property, sometimes, especially like a husband-wife team, maybe one of them would have a higher income, then that person might want to have a bigger load or bigger share of the rental loss so that that person can have a bigger tax saving when he or she is doing the tax return. Okay, so but when you want to do that, you need to understand how to set it up to make sure, legally speaking, you can do it that way. Okay, so in Australia, the way to set up your ownership when you purchase property, there are major two types: joint tenants and tenants in common. Okay, so joint tenants, to make it easier, it means if you purchase a property through joint tenant, you have to share the income and loss equally. So if it's like two people, husband and wife team, 50-50 share. Okay, if three people, 1/3 each. Okay, tenants in common, you can change the percentage share upfront, and once it's decided, it's fixed. So potentially, when you purchase a property, if you want to have 80% of the property, and then your spouse have the other remainder of it at 80%, then you have to let the solicitor know you need to set it up as tenants in common. Okay, if they don't, then you have no other choice in the future. When you prepare your tax returns, you have to share your load equally. Okay, that's really, really important, okay, especially if you're planning to buy an investment property to help to reduce your tax in the future. Okay, so once the initial ownership is set up, later on, if you want to change the ownership percentage, potentially it will result in stamp duty or capital gains tax. A lot of people don't know this. So let's say if you purchase an investment property and you have 20% of the share, your spouse has 80%. Then in the future, at the point of time, you want to change it to 50-50 share. Then the 30% of the ownership you are transferring between each other, you have to pay stamp duty and capital gains tax. Okay, that's related to investment property. Okay, for main residence is a different issue. We're going to touch base a little bit later. All right. So basically, as a summary, the legal interest decide how you're going to do your tax return for rental property. So regardless of loan proportions of who's going to pay majority of the expenses for the rental property. That's a common misconception. A lot of people say, okay, I'm paying most of the expenses, or even though it's, the title deed is showing a strong tenant, but I'm paying 100% of the loan interest. It doesn't matter, okay? Once the title deed is saying that it's strong tenant for you and your spouse, then it have to be 50-50% share when you're doing your tax return for the rental property, okay? So this is more when you're owning an investment property as individuals, not as a business, okay? So, and this scenario is covering probably 99% of the owners, investment property owners. But next slide, we're going to touch base a little bit on what will happen if you were running a property letting business. So the first question we need to ask is, when are you running a property letting business? Okay, so when say a husband and wife team, they might have multiple properties under their names, maybe say 20, 30 properties, then they basically use themselves as their own rental agent. So that means they need to advertise the properties to get tenants. They need to interview the tenants, choose them. They need to do repair maintenance for the properties, gardening. So basically, they are their own properties rental agents. Okay, so when they are running a property letting business, it doesn't matter what's on the title deeds. Okay, this is a major difference. It doesn't matter what's on the legal document. They have to divide their net rental income or loss according to the partnership agreement, if they have one. If they don't have a partnership agreement, they have to share it equally with each other. Okay, so that's a major difference if people are running a property letting business. Okay, so the top section on the slide is a list on the different criteria. How do we decide someone is running a property letting business? The size and scale have to up to a certain level. For 20 properties, 30 properties, for many properties, also the underlying value is very big. Okay, and then also the owners have to spend a lot of time, high number of hours managing the properties. Also, they have very extensive personal involvement in the activities. And then the manner of managing the properties is more business-like. So they are a little bit like rental agents, like running it as a business. Okay, so just briefly touch base on this one. Most people, they wouldn't be rich enough to have that many properties under their names. But just so that you know, if in the future, potentially if you get into a lot of money, and then you might be able to change to a property letting business, and then you know what's going to happen on the tax side. Okay. All right. Next slide. Okay. Loan setup. So this one, if you only take one piece of information from today's seminar, I hope it's this one, because it's really important. And people are losing a lot of money because they set up initial loan structure incorrectly. Okay, so the general rule of thumb is the loan money related to your investment property have to be separated from your private loan, okay, a loan on private purposes. So that means it have to be separated from your own residential loan. All right. If you can't separate it clearly, then the loan interest needs to be apportioned when you are claiming a tax deduction on the loan interest. Okay. So I have included an example here. This example is directly from ATO website, but I'm going to add some figures to it just so that it's easier for you to understand. So let's say Michael has owned his own property for quite a few years, and then potentially, let's say he bought the property price was $1 million. Okay, then he might have paid half of the initial price as a down payment. So he paid 500K for it already. Okay, so initial loan amount was 500K. And after a few years living there, he might have worked really hard to pay it back. Also, he might have received inheritance, okay, from a family member who passed away. And then, so after a few years, he might have paid back 900K. So he only had 100K loan balance left. And at this point of time, he's making a decision, okay, I want to move in to a bigger property. So he's doing a refinance to this property. And then through the refinance, he got 400K out. So basically, he's changing the loan amount back to 500K. And then he got 400K cash out to cover the initial payment to buy this bigger property as his own residence in the future. And then he's going to convert the old property as an investment property. So what's going to happen to him, the tax purpose? Okay, basically what will happen is because he has paid all the payments to the original loan account, so now after the change, the 400K he's getting out because it's related to a down payment of a private main residence. So main residence is categorized as private purpose. So that 400K is not deductible anymore. Okay, even though his loan balance is now again 500K. So when he's earning rental income for his old property, okay, he's going to rent it out and earn investment income, rental income. But the interest deduction he can claim is only on the 100K because that's the only part that's not related to a private purpose. Okay, so this is really important. So a lot of people make this mistake. But then how can he avoid it? So what if Michael say, okay, I had 500K before, and what can I do so that I can maintain the nature of the loan balance to make sure when I change or when I want to buy another residential property and then convert this one to rental property, I can still claim the maximum interest deduction on the loan balance. So, okay, so that's the point here. So next bullet point, when you set up your own, even though you're buying the first residential property, if possible, try to create an offset account. Create an offset account. And then when you have any surplus cash, try to pay it to the offset account to reduce your interest payment instead of paying the loan directly. Okay, so that means you are actually keeping the nature of the loan. Okay, you're keeping the loan separately. Okay, and then when in the future you want to buy another residential property, use your money in the offset account. okay? Then once you have, okay, so in Michael's scenario, let's use him as an example again. If he had done this before, then that means he can actually claim a bigger balance. Let's say at the time when he wants to purchase a new residential property, he might have a loan balance of say 400K. Then he might have done a refinance and get the money out. But or if all the money left in the loan balance, okay, all the loan balance left, that means at that point of time, he can use 100% of it as investment loan that's linked to the investment property. So when he convert the old property to a rental property. Does that make sense? Okay, so because you basically didn't change the nature of the loan, okay, all right, and then, okay, another issue, common question from clients. Sometimes mortgage brokers might suggest, okay, you can set up your loan in a certain way so that you can pay rental income to your residential loan first, okay, or pay to the offset account to the residential loan first, and then the effect of that is basically you are paying down your residential property loan faster than the loan on the investment property is paid later. Okay, so that means you're basically maximizing your rental deductions on the interest, on the loan interest. Is that allowed by tax office? Generally speaking, the answer is no, because that could attract Part IVA applications. So what Part IVA means is if when you are doing something, the only purpose is to get tax advantage, there's no other benefit at all, then that means you're trying to avoid paying tax. Then potentially you attract tax office attention and then attract regulations and the Part IVA. Okay, so just want to quickly touch base here because it's quite a common question. Okay. All right, now it's the question time on the topics we have touched base earlier. So does anyone have any questions? You can just type in on the right-hand side, or you can unmute your microphone and just ask the question here.
Hi, Brenda, it's Aidan.
Hello, Aidan.
Hi, I had a question around what you're talking about in terms of the changeover of the loan purpose. Yeah, so my question just relates to that changeover purpose. So if I had redraw funds in the home loan account prior to changing it back over to the investment home loan, does that impact the interest deductibility as well?
Sorry, would you be able to say that again? So you want to?
Because you're talking about it's preferable to have an offset account if you want to change over the purpose of the loan.
That's right, definitely, yeah. Yeah.
Then what happens if there's redraw funds in the account? So does that mean that can't be counted in terms of the home loan amount?
Oh, I see what you mean. So basically, sometimes the banks offer redraw facilities, right? When you get
Yeah.
Okay, but the issue is it still doesn't change the fact that the nature of the loan has changed. Does that make sense? So if you have, when you purchase your residential property, if you pay back directly to the loan account, even though they give you the redraw facility, but it doesn't change the fact that that loan, the nature of the loan balance, is still polluted, it's still changed.
Yeah.
Does that make sense?
Yeah. So if the home loan, let's say, is 500,000, but the limit is 500,000, but then you had redraw of 100,000. When you change it over, does that mean technically the investment home loan should be 400, or is it still 500?
It's still so basically, okay, even if you can redraw, so basically
Yes.
the moment when you change the nature of the property, that moment,
Yeah.
the loan is frozen to that
Yeah.
point. Does that make
Yeah.
sense?
Yeah. Yeah.
Whatever you have left in that loan balance,
Yeah.
the moment when you change the nature of the property from residential to investment,
Yeah.
that's
Yeah.
going to be the remainder of the loan balance. You can claim loan interest deductions.
Okay. So is it basically whatever the loan balance or the loan limit at the time of changeover is basically what you can claim?
Yeah, that's
Yeah.
right.
Okay. All right. Cool.
Even before you go,
Yeah.
please hear me now.
Sorry, I missed that.
Can you hear me now?
Yeah. Now I can. Yeah.
Oh, okay, that's cool. I think I found the problem. Okay,
Okay.
no problem. So now let's continue. Does anyone else have any questions? Okay, no other questions.
Yes, I actually put in a questions on the chat. It's about the CGT calculations.
Okay, yeah, no problem. Yeah, you can speak as well.
Okay. The question was if there is a CGT on if there is a two properties that I've had and I change myself every like 6 months
Okay,
into self-residency,
yeah,
and then the other property I will be letting out for 6 months, and then I'll go back into that property after 6 months. If I do that all the time, how would I calculate my CGT?
okay, very good question. So basically CGT, we're going to, you know, the 6-year rule, we're going to cover in the second part of the seminar.
Okay.
Yeah, so it's divided into groups. So the first section, we're going to focus on the ongoing income and expenses when you prepare your tax return. The second part will be focused on the capital gain tax calculation and how to minimize it. So in that section, we're going to touch base on the 6-year rule. But it's a very good question. It's very important. Yeah, we're going to go through in more details a little bit later.
Okay.
All right. Yeah. See whether after we go through the section, it helped to answer your question. If not, then you can ask me the question again. How about that?
Okay. Thanks.
Okay, perfect. Thank you. Thank you very much, everyone. So let's go back to the seminar. All right. I'll just share again. Now let's go back to the slide. Okay. The next section. Let me maximize. Okay. So when can you start claiming deductions? Sometimes people get this wrong and they actually miss possible deductions. So most people think that only after they started generating rental income, they can claim a rental deduction. It's not the case. So basically, when a property is available for rent, you can claim a deduction. Okay, so what is when is a property available for rent? So when you can show a clear intention to rent the property, so you're showing that you really want to rent it out. Okay, and then the property is advertised in ways which give it broad exposure to potential tenants. The key words here are broad exposure. So if you only just inform a few friends, your family members, hey, I want to rent this rental property, is that broad exposure? It's not. So it have to be on is a probably social network or advertising on real estate. So you can reach a lot of people in the public. Okay. Then also you need to have regard to all the circumstances. So when you look at the property, it's very possible a tenant will want to live there, okay? And then there can be unreasonable rental conditions. So what are unreasonable rental conditions? One example, there can't be any children, so no children. Then a lot of families have children, so that's definitely unreasonable, okay? Just an example, all right? So there are some expenses you can even claim before a property is available for rent. Okay, so interest on loans. So when this is actually during renovation. So when you get after you purchase a property, it might be a little bit old. You need to do a lot of renovation to it. Then during the time of renovation to get it ready to be rented out, and then during that period, you can claim interest on loans, council rates, water and sewage rates, and land tax, and emergency services levies. Okay. All right. One thing very important, the timing of repair and maintenance. So basically for repair and maintenance, if it's related to the ongoing wear and tear when tenants live there, as a result of a tenant living there, then you can claim a full deduction in the tax year that you have incurred the expenses. Okay, but very important, initial repairs for damage right after you purchase an investment property, the costs have to be combined with your purchase price or need to be forming a part of your cost base to reduce your future capital gain. So that's going to delay the deduction for a long time if you're going to sell the investment property many years later. So this is very important. Okay, so what will happen? So it's always recommended if you notice there are damage or repair maintenance that need to be done, potentially you can get a tenant in, or if it's already kind of livable, maybe just a doorknob is broken or wall is damaged, you just need to patch it up and then get a tenant in first, or you can potentially give the person a discounted rental, and then after that person lives there for a while, and then you get, or during that when that person's living there, you get someone in to do the repair. Okay, then if that's the case, you can claim the expenses in that tax year. Okay, so also another concept I would like to mention here is the difference between repair and maintenance and capital expenses. The capital expenses are in the nature when you're replacing a whole unit of a rental property. So example here, when you're replacing entire kitchen or entire bathroom, but that expense is actually in capital nature. So when you're paying expenses in capital nature, you have to depreciate the expense in the following years. So you can't really claim deduction in that year. Okay, that's on capital expenses. Okay, make sure you can tell the difference. So what's a genuine repair and maintenance? Genuine repair and maintenance basically sometimes there is a genuine damage, such as maybe a doorknob is broken, or maybe the wooden floor is broken, so it's genuine damage. Then you only replacing or repair a part of that whole unit. It's not the whole unit. Okay. And then also when you're paying someone, a tradesman come in to do the repair and maintenance, make sure you request a copy of the invoice, or at least you need to check the supplier's ABN. If they don't provide an ABN to you, you can't claim a deduction. Or if they don't provide, basically the tax office requirement is you need to deduct a certain amount from it, so 47% of the invoice price and pay it to tax office as a withholding you're paying for them. In reality, it can't happen because the tradesman wouldn't accept basically a discount of 47% from you. So that means if you are paying cash and then you don't have valid copy of tax invoice, or if you don't have their ABN number, you can't claim deduction for your rental property for the expense. Okay, that's this one. And then on the expenses, you can actually prepay some expenses. So why do people pay prepaid expenses for rental properties? Two different scenarios. Sometimes you might have to, say for insurance payment, it's actually covering 12 months calendar year. It can start from the middle of a tax year. Then, of course, it's going to cover a part of the following tax year. Sometimes people voluntarily pay expenses earlier because, say, for an example, if you know already next year your income level is going to change, okay? So you know next year your income is going to reduce a lot. So that means you want to claim more deductions this year. Maybe you have higher tax. Your income this year is falling in a higher tax bracket. Then you want to claim more expenses this year than next year because you know you can claim better deduction. Okay, save more tax this year. That's a different scenario. So before you make any prepaid expenses, you need to make sure you understand. So what's allowed? Okay, so if it's less than $1,000, you can claim deduction right away. So in that year, and then if it's more than $1,000, and then the underlying service period is more than 12 months, then it needs to be amortized over 2 or more years. Okay, so depending on the underlying circumstances. That's on prepaid expenses. Okay, so do you have any questions? Does anyone have any questions for this section? Not really. It's quite a simple section, right? Okay, that's cool.
Brenda, just a quick question.
Yeah, no problem.
So what happens if you want to self-manage your rental property?
Self-manage?
Yeah.
You can.
So in that regard, what type of requirement is needed?
Okay, self-manage, you mean that you're not renting through a rental agent, right?
Yeah.
Yeah, you can do that. It happens quite often. It's quite similar to, say, when you're renting part of your main residence. You know, when you rent a bedroom, you receive a rental income and you pay expenses. So the requirement will be the same. So basically, on the rental income, you basically calculate how much rental you're receiving per week and then calculate the whole year's income. Then on the deductions, you still need to have all the written evidence. You know, if you repair and maintenance only related to that room, then you need to have a copy of the invoice to back up your claim. Does that make sense?
Yeah. But then in regards to finding the tenant, is it just a normal like advertising on, say, realestate.com or domain.com?
Yeah, definitely.
Yeah. Okay. Awesome.
Yes, that's the case. Okay.
Thank you.
You're welcome. Any other questions? Okay, if no other questions, we'll continue. Okay, give me a quick second. I'm just going to grab some water for myself. Okay, let's go to the next section. Okay, borrowing expenses is quite commonly missed by a lot of people as well, especially if you are preparing your tax return by yourself. Occasionally, even accountants might, if they don't request it, and then you don't know, then you might miss borrowing expenses as well. So what are borrowing expenses? They are directly incurred when you're taking out a loan. Okay, So where to find them? They are normally in the loan agreement. Initially when you borrowing loan from a bank or through a mortgage broker, they will give you a loan agreement. You have to sign on that document. So they are listed in that document. Okay. Potentially, if you already have a copy, you can just dig a copy out and have a look yourself, and then you can find the items there. Okay. So we put a list here. So basically, borrowing expenses include loan establishment fees, normally a couple $100, title search fees, okay, charged by the bank, and then cost for preparing the documents, mortgage broker fees, stamp duty charged on the mortgage. So here, stamp duty is not related to the purchase price of the house. It's related to the mortgage only. So make sure you understand the difference, okay? Because the stamp duty here is going to be quite small. The stamp duty for the house need to be included as a part of the cost base of the house to reduce your future capital gain of the property. We'll touch base later. But here, the stamp duty is only on the mortgage. Okay, so much a smaller amount. And then also fees for valuation, for loan approval, and then lender's mortgage insurance. This is going to be, if you do have mortgage insurance, this is going to be making a bigger portion of your borrowing expenses, because once you have it, it's normally a few $1,000s. But if you miss mortgage insurance, then it's going to, you're missing out a lot of tax deductions. Okay, sometimes for new clients, if they didn't know this, we actually went back a few years to help them, just so that they can claim it back, especially their mortgage insurance. Okay, all right. So with borrowing expenses, how it's going to be deducted? If the total amount is less than $100, then you can claim the full deduction in the current year. Okay, less than $100. If it's more than $100, it have to be amortized in 5 years or the remaining term of the loan. So if the remaining term is 3 years, then you can claim it 3 years. Okay, but normally with a residential loan, it's going to cover like 20, 30 years. So 5 years is the most common time that you're going to amortize borrowing expenses. Okay, another tip, try to use rental agents to pay expenses to avoid missing deductions. So this happens a lot with our clients. Sometimes they, even though they are using rental agents, they are already paying their fees, but they're still paying council rates, water rates by themselves. Not only is time consuming for themselves, at the end of the year, if they lose some of the invoices, then they lose the deductions because they don't have the written evidence. Now, council rates, water rates, most of the time, you can call the council, call the city water to get the invoices back. But for repair and maintenance, things like that, once you don't have it, it's really hard to get another copy of the invoice. Okay, so try to use rental agents to pay the expenses, because you are already paying them for on their fees, managing your properties. Okay, so try to use them more. All right. So next topic is quite a common question as well. So when you're renting out to related parties, so what's going to happen? It happens quite often. Clients might have property, an apartment that's rented out to siblings or parents. How can they report their tax on those properties? The first thing they need to look at is the rental income they're earning from the tenant. Is it matching the market rate? Okay, in the suburb, the same suburb. If it's matching, then it's going to be very similar to a typical rental property. Basically, they include normal the rental income and include 100% of other expenses as deductions. Okay, if it's not matching to the local market rate, then they need to apportionate expenses on deductions. So let's say if the local market might rent $500 or $1,000 a week for a property, then to a related party, you're only renting out $800 a week. And that means on the deduction side, you can only claim 80% on the expenses. Okay, so you have to apportionate expenses. Okay. Okay, when you're renting out part of your house, so it happens quite often too. People rent out one room or one level of their main residence. Okay, then they have to report it. If they earn rental income, then they can claim a percentage of their expenses related to that room or that section of the house as their deductions to reduce rental income. Okay, so basically, how to apportionate it is they need to make a measurement, so square meters. What's going to be, so they need to measure that separate section that's solely used by the tenant. And then they need to measure the whole house, and then calculate a percentage, and then use that percentage to calculate their total deductions. Okay, it can happen sometimes. You might have a shared area with a tenant, such as a living room, maybe the garage. If you have a double garage, maybe they can park there as well. But those areas, you also need to measure the square meters and then also apply another percentage that when you're sharing that area. Okay, so if you have a double garage and then 50% of it was given to the tenant to use, then you can calculate the square meters and then calculate 50% for that area, and then claim deductions related, okay, proportionally as well. Okay, one very important concept here, when you are earning income from your main residence, main residence is actually a CGT exempt, so you don't need to pay capital gains tax for a main residence. But if you are earning income from part of it, then for that portion of the house, you do need to pay capital gains tax in the future. Okay, just proportionally calculate a part of the capital gain, and then you need to pay tax only for that portion that you have earned rental income. Okay. All right, question time. Does anyone have any questions? Nobody have any questions? Okay, so this section is quite straightforward as well. Okay, now let's go to the next section. All right, so this section, so now we're going to the second part of the seminar, which is going to focus on how to reduce your capital gains tax when you're selling investment property. Okay, first of all, let's have a look at how capital gain tax is calculated. Okay, so the first part.
Sorry, is the sound still on?
Pardon? Let's have a look. What's happening, Aiden? Oh, you can actually mute. Let me mute your sound. Okay, so I've muted everyone's sound, but you can unmute anytime by yourself. All right? Okay, very good. All right, so let's go back to the slide. So the calculation of capital gain, the first part, you need to calculate the gain. So what's going to be the dollar value of the capital gain? So basically the calculation look quite simple. It's the capital proceeds. So basically it's the sales price of your property, okay? Then minus cost base. The cost base is going to be one of the major focuses. We'll touch base later because it includes many different components. Okay, we'll touch base later. Then once you know the amount of the capital gain, then the tax will be paid on top of your other income on your marginal tax rate. Of course, that's going to be after applying a discount. Because if a property is owned by an individual or a family trust for more than 12 months, you do have a 50% discount on the capital gain. So basically, once you know the dollar value of the capital gain, you use 50%, basically reduce it by half, then you apply that amount on top of your other income to pay marginal tax. Okay, and if you are holding the property for less than 12 months, then you can't really receive that discount. You have to pay the tax on the full amount. Okay, that's basically for capital gains tax, how to calculate it. And now let's have a look at the cost base. The cost base, if you want to reduce your capital gains tax, of course, one of the best ways is to increase the cost base. If in case you miss any items here that is actually legit items you can claim deductions, then you're losing tax on the components. Okay, so there are 5 main elements on the cost base. Okay, the first element, money you paid for the property. So quite simple, the purchase price. Second element is incidental cost related to purchase and sales of the property. So basically, they include professional fees, conveyance, solicitor, valuer, auctioneer, accountants, those costs you have paid out related to purchase and sale of the property. And stamp duty. Remember we mentioned earlier, stamp duty will be included as a part of your cost base, right, when you calculate capital gains tax. Then advertising or marketing when you want to sell the property, and title search fees, and other similar costs. Okay, that's the second element. Third element is the cost of owing the CGT asset, actually. Okay, so basically, if you have claimed deductions for them before, then you can't add them in your cost base again when you sell the property. If you have claimed council rates, insurance, land tax from year to year to reduce your rental income, you can't claim them again when you are selling the property to include these expenses as a part of the cost base. Okay, but if you never claimed them before, then you can add them to the cost base. Okay, that's the third element, cost of owing the CGT asset. Okay, the fourth element is capital cost to increase or preserve the value of the asset. If you do any change to it, such as change the zoning, you apply to the council to change the zoning, maybe do a subdivision, okay, or you might install new items to it, okay, or remove items. Anything you do to preserve or increase the value of the asset. And the fifth element, if you incur any cost to preserve or defend your title, so sometimes there might be legal issues, and then you need to show that you are the owner, the legal owner of the property, or a section of the property, then that legal cost is related to this part, okay, under the fifth element. So that's all the 5 elements on the cost base for when you calculate capital gains tax. Okay, anyone have any questions? You can speak or you can type in on the right-hand side. Okay, nobody have any questions? Okay, let's go to the...
Brenda.
Oh,
Brenda.
hello, yeah.
Yep. For the fourth element, are you referring to renovations and upgrades, or maybe repainting the houses or as such?
Yeah.
So, for example, if I purchase a old house, okay, or on a second-hand market, I do an fix and upper, and then I sell it. So the money that I put in for cosmetic or in the improvements of selling, so that counts towards my CGT, correct?
Definitely.
Okay.
Include the expense you paid as a part of your cost base to reduce your capital gain. Definitely. Yeah.
Okay.
Yeah, that's good. Okay, very good. Any other questions before we go to the next section? Okay, let's go to the next section. Okay, so this one is, we had someone before asking this question about the 6-year rule. So this is very important. A lot of people have this question, okay? So generally speaking, as we mentioned before, we have exemption for main residence on capital gains tax. Okay, we don't need to pay capital gains tax for our main residence. Okay, the general rule is when you stop living somewhere, okay, or when the dwelling ceases being main residence after you stop living in it, it stopped being your main residence. But okay, if you stop living in your main residence for up to 6 years and then rent it out to have a tenant, and provided if you move back to the main residence to end the 6 years, that you can still treat it as your main residence. Okay, so 6-year rule is more when you're renting it out to produce income. So if you actually move out and you're not renting it out, the period is indefinite. So you can leave it vacant for any number of years. You can still choose to select this property, elect this property as your main residence. Okay, so but the catch is you can't treat any other property as your main residence for the same period. Okay, except for a limited time when you're moving house or touch base a little bit later. Okay, so I'm going to give you an example so that you have a better understanding how to utilize the 6-year rule. So let's say, for example, because we are based in Bankstown, we say I bought a property in Bankstown for $1 million. Okay, then I bought another property, same price, $1 million in Bandai, one apartment. Okay, then 5 years later, so basically I lived in both of them, okay, initially. So, and then I rent one of them out. 5 years later, I noticed, okay, I actually want to sell one of them. And then I noticed the property in Bandai increased to 1.5 million. The property in Bankstown increased to $2 million. And then I want to sell the property in Bankstown. Of course, then I want to elect the property in Bankstown as my main residence because it's quite clear it is having a bigger capital gain than the property in Bandai. All right, but the catch is after I used the 5 years as my main residence, so I already basically once I use it up, so for that 5 years, I have basically mentioned, okay, I lived in Bankstown in this property. Then in the future, say 5 years later, when I sell my Bandai property, I can't say in that 5 years I live in Bandai property as my main residence again. Okay, so when I sell that Bandai property 5 years later, so I have owned it in total for 10 years. So for 10 years, 5 out of 10 years, I have to calculate a capital gain, pay capital gains tax for that property. Okay, hope that makes sense. I'm going to, when we have the question time, I'm going to go through your questions and answer them together. Okay, and then, okay, So the question is, when is a property, when is it your main residence? Okay, when you and your family live in it, or your personal belongings are kept in it, or is the address your mail is delivered to, or is actually registered with the government on the electoral roll. Okay, and then services, gas, water, power are connected. Okay, and also it's not just based on one factor or even a combination of a few different factors. So normally tax office would mention you have to allocate a weight on different factors and then make a decision on the overall circumstances based on different situations. All right, and then the last point of the slide is quite important too for people to understand. The 6-year rule or exemption, it doesn't apply when a property does not stop being your own residence. So what happened, I'll give you one example. Maybe a family will go away to have a holiday a year, say for 3 months. So the whole family will go, and then for that 3 months, they might get someone to live in the property, and then the tenant is actually paying them a rental income during that 3 months. Then can they say that I stopped living in the property for 3 months, and then therefore, because it's less than 6 years, I can claim an exemption? It's not the case. Remember we mentioned before, when you're renting part or all of your house, you actually need to pay capital gains tax for that section. But in the same scenario, when your possessions are still there, when you finish your holiday, you're still coming back to it. So it's still your main residence, so you haven't stopped. So that means for 3 months of the year, or at the end, when you're selling the property, you actually need to record the 3 months as you have generated rental income from your main residence, and you need to pay capital gains tax on it. And in the same scenario, when you're renting out a room or a section of your house while you're still living there, you haven't stopped the property being your own residence, your main residence. That means at the end, when you're selling that property, you can't claim the full exemption. Okay, you still have to pay capital gains tax on that portion of the house you have rent out. Okay, this is it's a little bit confusing, but I hope the examples help you to understand. All right, and then okay, we mentioned earlier when people are moving house, so we'll just briefly touch base on this. When you're moving house, so between the old main residence, the new one, you actually have a 6 months, provided I put some criteria here, that's from tax office, but provided you are meeting the criteria, so you can, in the 6 months period, so basically change over time, you can treat both properties as your main residence and claim exemption for it. So that's the only condition, okay, only situation you can claim 2 properties at the same time as your main residence. Okay, 6 months when you're changing your main residence. All right. Okay, question time. I think we have a few questions here. Let me have a look. I can go to chat. How is CGT calculated 2 properties? Okay, would you be able to speak up? It might be easier because when I read the notes, it's not very clear on your questions.
Well, the question was, if I have 2 properties and then I live in it for 6 months and then rent it out for 6 months, and I change because again, I might be traveling from 2 different cities. So yes. I live in one city for 6 months, and The other property is also 6 months. So both of them is my main residency. But of course, I need to pay a portion of the CGT. But how would they calculate it?
Mm-hmm.
So, for example, first 3 years, okay, I have a periodic change of 6 months residency on both properties. So the increase of the property prices, that would be my capital gain I'm expecting, and then I need to pay 50% if I'm going to sell the houses, and then how do I calculate one part of that CGT?
Okay, so did you earn rental income for any part?
Yes.
Oh, you did. Okay, so then in that case, did you know, when we look at the main residence, let's go back to that slide. When is a property your main residence? So when you're changing from one property to the other, did you change your address? You change your electoral roll?
Yes.
You did? Okay, then in that case, if the overall situation is showing that you are basically changing to one property, then you rent the other property out, then you can say you have changed, basically stopped living in one of them as your main residence. Then that 6-year rule does apply. Does that make sense?
Not really.
You need to go through what's the tax office regulation on when a property is your main residence. Does that make sense? So basically, when you look at if you're not living in it, so basically when a property stopped being your main residence is when you put a no to all the different criteria. Does that make sense?
Okay.
Oh,
Okay. So in that case, that could be my main residence.
yeah.
Okay. Furthermore, if I need to sell both of the houses at the same time, so which one? So is that the only way that I can claim one property is my main residence, the other must be a investment property, or both can be count as residence, main residency?
It can't be both, because you can't really use, so any period of time, any point of time, you can't have two main residence.
Okay.
And so you can only claim exemption for one of the properties. Does that make sense? So once you bought two properties at the same time, you're selling them at the same time, and then provide for both of them, you're meeting the 6-year rule, you can only choose one of them as your main residence to receive the CGT exemption.
Okay, understood.
Yeah.
So what happens if after 6 years as well?
Pardon, say that again, sorry.
What happens after 6 years? Like I rented my property out for 7 years, and then I moved back into the property as claiming as a self-residence on that property. Yep. So what happens?
Provided if you move in before the 6-year rule expires.
Yeah, how about after? That's my question. After. Is there any CGT exemption?
No.
Okay. Yeah. So the criteria is you can only make rental incomes within 6 years of time for CGT exemption.
That's right.
Correct?
Yeah. So up to. So you need to make sure you go back to it. You move back to it within 6 years. So sometimes it can happen. It's a little bit of a hassle, but occasionally it can happen to people who have 3 properties, but they move around. That makes sense? Yep. They actually monitor how much time, okay, how many years I have running out. And then they move out before 6 year expire for all of them. Then after how many years, when they want to sell one of them, then they'll consider, okay, which one will give me more capital gain? Then they choose that one. Does that make sense? But it's a little bit, yeah.
It does make sense.
Yeah.
So does this exemption can only be calculated once? Like, for example, first 6G, I have 3 properties, and then I'm going to sell one which have the most capital gain tax.
Yeah.
And then maybe three years down the track, I still have 2, for example.
Yeah.
Okay. So 3 years down the track, if I need to sell the second property, does that CGT exemption still apply, or I have to wait another 6 years?
Partially. So basically, for the first property you have used, the years you have used up when you sell this property, for those years, you can't use it again. You can't use it again to claim that on the other properties. Does that make sense? So let's say you have 3 properties, and you have them like for the after 5 years. So they're all meeting the 6-year rule requirement. And after 5 years, you want to choose one of them that's actually giving you the biggest capital gain. Then so you sell it and then you claim the exemption. Then 3 years down the track, you want to sell another property. So you have like two remaining. And out of 2, you can still choose one of them that's going to give you a bigger capital gain as well. But the capital gain exemption is only going to apply to 3 out of 8 years. Does that make sense? Because the 5 years you have used up for the property you have sold.
Okay, understood.
For the second property, you have owned both of them in total of 8 years. But 5 years was already used up when you sell the first property. So you can only use 3 out of 8 years for one of them to claim capital gain exemption as your main residence. Does that make sense?
Okay, understood.
Yeah.
So the next question is also, is the CGT exemptions applied to overseas buyer?
Yes. If you have a main residence as overseas as well. So it can happen quite often. Sometimes especially people they might have moved from China to Australia, let's say, and they might have a property there they want to keep as their main residence. That's possible too. And then they can rent it out, for 6 years, provided if they move back. And then, but at the same time, of course, they can have another property in Australia. So that's the 6-year rule still apply. So they can rent out their overseas property. So before it's expired, they move back. Might be a big hassle for them to move back, but provided if they are meeting the 6-year rule requirement, then they can. Yeah, they can still elect one of them as their main residence.
I mean, is this CGT because of the visa requirements, for example, TR, which is temporary residency, they still have to pay overseas buyer's tax. So, but they do not have the rights to purchase a second. Oh, they do have the rights to purchase a second-hand from second-hand market, but they need to sell it once before the visa is expired.
Yeah. There are other complications on visa holders. Yeah. So So basically, for PR, for local residents, that's generally the rule. But if they're visa holders, they only come to Australia on a work visa or a different visa, they have different requirements.
Okay.
Yeah, but if you have any questions, maybe we'll touch base later on after the seminar.
Okay. Yeah, sure.
Yeah, it's not a part of the common issues. Yeah, especially after the government changed the whole regulations, for overseas buyers a couple of years back. So there are other complications related to overseas buyers for properties. Yeah,
okay, understood. Yep.
We can have another conversation after the seminar.
Sure.
All right. Okay. No problem. Very good. Thank you for the questions. Sometimes the questions will help everyone to have a better understanding. Yeah, if in case I didn't provide enough details when I go through the topics. Okay, so now, are there any other questions? If not, I'm going to continue to the next section. All right, okay, let's continue. Okay, so that's going to be the last section, just a couple of slides. Just want to touch base on when you're selling properties to a family member or friends. So when you're selling property to related parties, the main residence exemption still apply, okay? And then, but if in case when you're transferring the ownership to them, the market value will apply. So basically, if you are selling more or less than the market value, then you need to make sure you either get a valuer or use a reasonable method yourself based on the local rate, local property prices to calculate maybe an average price, or you need to have some reasonable ways to calculate the value. Then you have to use that amount to calculate your capital gains tax. Of course, there are other exceptions. So when there's marriage breakdown, or when you're transferring property to a special disability trust, but because it's not quite common, it's not common scenarios for all taxpayers. So if you have any questions, you can ask me later. Okay. All right. Then another possibility, if you are generating a lot of rental income and you want to get your family members to help you to share the load of the tax payment on the rental income, you can potentially move them to investment, to a family trust. So when you purchase a property, you can potentially purchase them under your family trust, or you can move investment properties to a family trust. So the benefit of it is you can actually spread your income to family members. Okay, then if you have children, so basically if they're under 18 years old, if they receive $416 from the family trust, it's tax-free for them. And then you can also claim the 50% capital gains discount. Okay, when you're selling the property, you're holding it for more than 12 months. Okay, so that's a benefit on the tax side. And then also you can have asset protection as well. So basically, because it's in a different business structure, then if something was to happen to you, if you have a bankrupt, or basically if you are running a business and people sue you, it's going to be really hard for them to tap in your asset in a family trust. Okay. Also, there are tax benefit or advantages on estate planning as well. When you want to, in the future, when you want to pass your assets to your children when you pass away in the future. Okay, there are other advantages. Disadvantages: setup costs could be quite high, and then also ongoing costs. The cost you're paying to an accountant or tax agent can be quite much higher than if you were having the property attached to under your own names, individual names. Okay. Also, inside the family trust, rental loss can't be distributed. So basically, if most of the time you with a negatively geared property, you can use a rental loss to reduce tax on other income. But in a family trust, you can't distribute rental loss. Okay, so it's actually trapped in there. Also, another thing I think I didn't include in the slide here is high tax on minors. So you can't really pay them more than $416 because that the maximum tax you need to pay will be 66%. So it's actually quite high. So that's another disadvantage. Okay, I think that should be everything for our seminar today. Does anyone have any questions? So if we go back to all the topics, do you have any questions on any topic we have touched base today? You have a chance to ask a question before we finish the seminar.
Brenda, is the presentation available, soft copy?
Oh yeah, definitely. So to anyone who want to have a copy of the slides, send me an email. then I'll reply and attach a copy to you.
Great, thank you.
Okay, no problem. Okay, any other questions? Okay, in that case, we can finish the seminar today. Thank you so much for attending to everyone. Our upcoming seminars in the future, we have another one next Saturday that's going to be focused on structure, business structure. So for anyone who's maybe running a sole trader business or you're considering of opening a new business, then you can join in, or for people who are having a lot of rental income, as we mentioned before, on family trust, if you're interested in setting up a family trust down the track, please join in. So the time will be the same. So next Saturday, 10 o'clock in the morning, there's going to be a seminar focused on business structures. Then the following week, or maybe the week after, I'm going to hold another seminar that's focused on 2020 tax return. So a lot happened this year because of COVID-19. So the tax returns will be quite different, or there will be quite a few difference from prior years. So once I settle for time, I'll send everyone an email invitation as well. Okay, thank you so much for attending, everyone. Okay, we have. Okay, thank you, everyone. Okay.
Thanks, Brenda.
Okay, thank you. Okay, very much. Have a nice weekend, everyone.
Bye.
Okay, bye-bye. Bye-bye.
Bye.